Hello, I'm Darine Abougaida. This is Counting the Cost on Al Jazeera, your look at the world of business and economics. This week, the perfect storm, pandemic, drought, and China's demand. Food prices hit 6-year highs. Just how high could they go? Argentina is famous for its beef, but the pandemic and inflation has sent demand to its lowest since the 1950s. Also this week, Ethiopia becomes one of 40 nations to seek pandemic debt relief, but there's fear many more won't step forward. We'll tell you why they're at the mercy of debt rating agencies. The $21 trillion U.S. government bond market has been in fits of turmoil amid concerns central banks' support for the economy could lead to an uptick in inflation. And that sent the tech-heavy NASDAQ into correction territory, meaning it lost 10% of its value. Investors sought assets and commodities that can weather an inflationary storm, like the dollar and oil. Both rose. Well, the question is, are those inflationary concerns real? Well, there's plenty of evidence that global food prices are on the rise. Take a look at this. It's the UN's Global Food Index. With 2014 to the left of your screen, the chart is almost like a bathtub, with another sharp rise in 2020 and hitting a 6-year high this year. Well, as you can see, the main food groups, there they are, they're all steadily climbing. So you have cereals, oils, dairy, meat, and sugar. They're all tracking higher, according to the UN's Food and Agriculture Organization. Well, what's behind the increase in prices? It's a combination of things: increasing demand from China, adverse weather conditions, and pandemic-hit supply chains. But it's nations like Brazil, Lebanon, and Nigeria that are adversely affected. In Brazil, for example, President Bolsonaro attempts to revive his political standing by handing out coronavirus aid to the poorest, inadvertently pushing up the price of rice by 76%. Now, in Lebanon, the country is in the midst of the worst financial crisis. A pretty worthless currency has sent inflation to a record high and food prices soaring by 400%. And in Nigeria, the central bank may continue to devalue the currency as it did 3 times in 2020. Closing the border for 16 months, attacks on farmers, and import restrictions have all exacerbated the situation. Now, the government has been trying to reduce imports by increasing production. More than 1 million farmers were given cash and tools. But officials say they're planning to take thousands of farmers to court for failing to repay loans they took out to cultivate rice. Ahmed Idris reports from Arungugu.
Abdullahi Megandu watches closely as farmhands prepare new paddy fields for a new crop. A few meters away, other workers tend to new shoots. Maigandu is one of Nigeria's major rice producers, with hundreds of hectares of land dedicated to growing rice. He says serious farmers like him are benefiting from a government loan scheme to boost domestic production, but says the scheme faces risks.
The real farmers are paying, which means there is success. Now, I have no apology to mention. There are certain category of people, you give them, they don't do the farming, and then they will be a challenge to you. They will say, it is a gift given to us.
Isa Wanzam leads a 34-member farmers cooperative and says they weren't told they would have to pay anything back.
If it was made clear to us that it's a loan, we'd have known how to approach it. We didn't apply for it. So I can tell you that we won't pay back a dime. Not all of it was money. We consider it as gifts or assistance. After all, we see politicians take public funds with no accountability.
The so-called Anchor Borrower scheme encourages farmers with small holdings to produce a variety of commodities and to connect producers with processors. But 5 years after the program was introduced, Nigeria still imports foods the scheme was meant to produce in excess.
Since 2015, an estimated $600 million has been provided to more than 1 million farmers to boost rice production. Critics of the process say it's corrupt and lacks transparency. They accuse government officials and politicians of hijacking a scheme that could now collapse because of a failure to pay back the loans.
An estimated 40% of those who have received money have either failed or refused to fully repay. Some officials say that's often understandable.
Though very slow, but one can understand that for one reason or the other, some payments sometimes can be slow. Especially the last time we had flood. So you can imagine our farmers lost a whole lot.
Africa's most populous nation has 34 million hectares of arable land, but only 33% is under production. This country of more than 200 million people imports much of what it eats. Agricultural experts say that's because farming technology is out of date, and if the government doesn't encourage mechanization, nothing will change.
Well, joining me now from Rome is Abdolreza Abbassian. He's a senior economist at the United Nations Food and Agricultural Organization. Thanks very much for joining us. So how concerned should we be about rising food prices? And is this entirely down to the pandemic?
Well, when food prices go up, it is always an issue for consumers. It is seen very positively by farmers. Just listening back to the discussions you had earlier, I think that it is a pity that in many developing countries, farmers will not benefit from the higher prices. So they tend to get the worst of the two worlds. On one hand, they have to pay more, their consumers, they're vulnerable countries, most of them. And on the other, their farmers will not be able to respond to higher prices and benefit from higher income that higher prices could bring to them. The level of prices today, as they are obviously high. They're not at the highest levels. They're still well below the kind of prices that we saw in the previous serious price surge that happened in period between 2008 2011. However, our food price index, the FAO food price index, has been going on month and month for the last 9 months, I would say, it is now kind of the highest since 2011. So it does give an impression that we are in a market where one could expect prices to remain high still for some time.
So does this mean that there is enough food in the world to meet demand?
Yes, when we are talking about a global situation, and let me be a little bit more precise here, the measure that we publish every month really is a barometer of what's happening in the global market. Individual countries at national, sub-national level, obviously situations could differ quite drastically from one place to another. Globally speaking, in fact, one of the lessons from the COVID that perhaps wasn't expected and is a positive one, is that the agriculture system globally, the trade globally, seem to have not been as much affected as people feared by the COVID. And that the supply situation overall has been quite adequate. And despite all the difficulties and even at the beginning, fears about logistical issues, transport, really for bulk commodities, basic foods such as cereals, such as vegetable oils, sugar, meat, dairy, we really didn't see much disruption in trade, and supplies have been adequate to meet the demand at the global level. And that we have to be very careful with that, because what COVID has done in many parts of the world is that it really had cut people's income. That means access to food. So the food may be in a country, and probably it is. But the question is, if I have lost my employment, if I don't have job, or if my earnings has come down and I have to feed my family, what food will I go and buy? And how I will go and buy it. So really the focus has been more on the demand side in this episode of higher prices than on the supply side.
Okay, and speaking of the demand side, how much of this has to do with the demand coming from China?
Well, I must say that the China factor has been quite important all the way, I would say, even predating the COVID situation. So it's not really COVID related. China is fighting a very big problem domestically, which was the African swine flu that basically destroyed its pig sector. So that had to be sorted out. That had quite an implication for global meat market, as China came into the market to buy meat. But then the recovery of that sector in China has been quite astonishing, meaning that China would have needed feed as well to import and feed the animals. So China became a huge importer of, for example, corn. imports well beyond anybody expected. And that fell into kind of a situation where we had COVID and we had China and US having an agreement called Phase 1, under which China was going to buy a lot of agricultural commodities from US. So it's really I would say it's not one single factor, but there were few things that came together in a very short period of time. And altogether, they have really had quite an upward push toward prices of almost all agricultural commodities.
So
yes,
how much of the
China
premium
has
of that premium? How much of that premium in food prices is then down to speculation and also fears of inflation driving up those commodity prices?
This is very difficult to answer, if I may say, because a speculative let's say decisions are made at every level, from farmers level perhaps all the way even to the consumer. You tend to store more if you think prices will go up in the future. Now, depending on where you are in a value chain, some of that could of course influence overall. However, when we're talking about really the agriculture sector over a period of, let's say, 2, 3, 4 months, not over a night or 2 days or one closing in Chicago, fundamentals drive it, right? So there is not right now a fear of an inflation like we had seen, for example, in 2007, 2010 period, where in fact some speculative activities as a way of hedging against future inflation meant let's go and buy commodities. I don't think that we are experiencing that. If we are experiencing something is more, let's say, at the local level where people may be expecting, I'm not going to sell now because I know prices will go up higher. But uncertainties are huge, and usually speculators benefit from uncertainties. The biggest uncertainty is not supply of agricultural commodities, is the economic conditions.
Okay, thank you so much, Abdolreza Abbassian, for speaking to us from Rome.
Thank you so much.
Argentina is world-renowned for its cattle that feed on the rich grass of its central Pampas region. But records show that last year, a large part of the population stopped purchasing meat. And that's partly because of the economic impact of COVID-19. Teresa Bo reports from Buenos Aires.
Grilling beef for hours is part of Argentina's tradition. Raúl Bob is proud of what his family has achieved. They're experts in preparing the traditional asado or barbecue, the grilling method used by the gauchos or skilled horsemen who roamed Argentina's Pampa region in the 18th and 19th centuries.
We are proud to say this is a restaurant that feeds everyone, all social classes, those who have money and those who don't. But things have changed. It's becoming more and more expensive. Those who come have less money.
The pandemic has forced restaurants like this one to adapt. It's working at 30% of its capacity. What complicates the situation even more is that beef is becoming more expensive in a country where people are used to eating meat nearly every day. Latest reports show that beef consumption has dropped to an all-time low, or about 50 kilos a person a year, half the amount consumed in the 1950s. One of the reasons is a change in eating habits, but there is more.
Beef plays a crucial role in Argentina's culture. This type of asados are part of people's daily life, but in the past year the price of beef has increased around 70% because of inflation and an increase of exports, and that's why the government is putting together a plan that aims to reduce the price of certain cuts.
Due to rising prices, cows were taken last year to graze land instead of being fattened with corn. This slowed down beef production and reduced the supply. Experts in the area fear government intervention to control the prices. Back in 2008, government restrictions to prevent a rise in prices ended with a loss of around 20% of Argentina's cattle herd.
I think it's a political action trying to reduce the price of beef. We export only 3% of what we consume. If the government tries to act on the effect and not on the causes, which is the rise in prices of almost everything in the country.
Patricia Mori is a butcher who was forced to adapt her shop and sell other products. She says the increase in the price of beef makes it difficult for her business to thrive.
We've had a 40% decrease in the sales of beef, mostly because of price. Not everyone can pay for beef. People were used to eating it all the time, but that's not the case now. We're selling chicken and other produce so that we can get our sales up.
Beef consumption is a reflection of Argentina's economy. And that's one of the reasons why the government wants to guarantee people have access to it.
Viva la Argentina.
But failed policies of the past may end up hurting the sector that has made Argentinian beef famous worldwide.
The World Bank is concerned more countries won't come forward to seek help as part of the G20's pandemic debt relief program. The program is supposed to help 73 of the world's low-income countries to better manage their debts, giving them the ability to spend the money on health care. Well, the fear is debt rating agencies would downgrade their debt, meaning they would need to fork out more in interest payments, or worse, turn investors away because their debts are considered risky. Now, that happened to Ethiopia. Since seeking help, the yield on its bonds, or the interest it needs to pay, has risen to 9% from 6%. As exports dwindle, the country's debt has risen by 26% since 2016 to $27 billion. And for much of the past 2 decades, the economy has grown close to 10%, until, that is, the arrival of Prime Minister Abiy Ahmed in 2018. He had hoped to lift the economy towards middle-income status by privatizing transport, telecoms, and sugar industries, raising billions in the process. But with the conflict in the northern Tigray region, that's where the United Nations alleges atrocities have been committed by Eritrean forces, the pandemic and more locust swarms, its finances may come under strain. Let's get more analysis on Ethiopia from London. Joining us via Skype, we have Alisa Strobel, who's the senior economist for Sub-Saharan Africa at IHS Markit. Thanks for your time with us. So what can you tell us about the latest with Ethiopia's debt, and how close to a deal are they?
The IMF stated on the 23rd of February that it welcomes Ethiopia's plan to tap into the G20 common framework to rework its debt situation, as it would strengthen Ethiopia's debt sustainability, such as through the reprofiling of debt service obligations, thus lower risk of debt distress. Notably, the bulk of Ethiopia's public external debt is official multilateral and bilateral debt. So the focus of Ethiopia's engagement with the common framework is predominantly targeting official bilateral debt. With China being the largest bilateral lender to Ethiopia, we see that the disclosure of Chinese-linked contingent liabilities may complicate debt treatment under the common framework, especially with private lenders. Transparency may be an issue here. China does not publish its bilateral debt agreements, so it's possible that debt contracted is higher than estimated, and therefore larger potential additional contingent liabilities come up.
And I suppose what's frustrated many at the IMF and also the World Bank is that the private sector is taking somewhat of a free ride on the back of cuts from a G20 debt relief deal. Any progress there?
At present, the G20 has actually provided very few details as to how the common framework would be operationalized. Private lenders' participation in the G20 remains voluntary. In other words, as with the debt service suspension initiative, there's no enforced participation in the framework. To date, negotiations with private sector creditors in Zambia, for instance, have stalled over investor concerns of potentially inaccurate disclosure of the country's liabilities. So in order to achieve a wider creditor participation in the framework would need to address some of its shortcomings, namely participation, enforced participation and coordination, but also the framework would need to ensure that all bilateral creditors, including specifically Chinese state-owned lenders, would provide accurate and transparent accounts of their lending to eligible countries.
Yeah, and the private sector would say we just don't know what China is owed, and they too may be taking a free ride.
Yes, it will ultimately depend on the finalization of how actually the common framework will be operationalized in the end.
What about the IMF's plans? It seems to be setting up plans to deploy its own currency or special drawing rights. When it comes to Ethiopia, how useful would that be for the country and other countries that need debt relief or aid?
Generally, an increase in special drawing rights is expansionary and bodes well for economic activity. Special drawing rights were originally established to support a country's weak foreign exchange holdings. That is a concern for Ethiopia. They also are representing a cheaper means for a country to finance its liquidity demands instead of rather going into the international bond and loan market. At the proposed IMF level, low-income countries' special drawing right holdings would increase by a threefold, so providing certainly an alternative and a sizable balance of payment support during and in the wake of the COVID-19 pandemic.
Well, after 2 decades of near 10% growth, what's happened to the economy? We haven't seen those highs again.
Yes, one needs to note here that the double-digit growth Ethiopia has witnessed over the almost 2 decades was mainly heavily driven by investments by the public sector into large state projects, especially infrastructure. Hence, the country has been struggling with depleted foreign exchange reserves that were used to finance these projects, accumulating debt over time. With a commitment to lower public spending that is aligned with the IMF program requirements, it is now not surprising to see that real GDP is coming in at lower rates in the near term compared to previous historic rates. With lower public spending fueling the economy, we are expecting to see an increase in private sector participation instead.
Right, and with Abiy Ahmed's plans to privatize the economy, is that on track? And will that really help in turning the economy into a middle-income country?
So given the country's foreign exchange shortage situation, the government is putting a further emphasis on increasing the stake of private participation in key sectors that provide the fastest generating foreign exchange. One of which is banking and the telecommunications sector. The government approved 40% of its state-owned Ethio Telecom last year, for instance, and we've seen a large influx of international companies submitting their bids to enter this highly lucrative market. The call for proposals for the acquisition of the 2 telecom licenses were issued by the government is still in progress and will end April 5th this year. Generally, one can say that privatization of further state-dominated sectors will not come overnight and make Ethiopia quickly a middle-income country. The timing of Ethiopia's banking privatization, for instance, its process will be more as something a gradual transition, a phased-out process, so to speak.
Okay, Alisa Strobel, thank you so much for giving us your thoughts from London.
My pleasure. Thank you.
And finally, a global shortage of semiconductor chips is hurting high-tech industries, from the makers of game consoles to automobiles. The problem has highlighted the dominance of 2 of the world's leading chip makers, Taiwan and South Korea. Rob McBride reports from Seoul.
Between them, South Korea and Taiwan have a near monopoly on the world's production of processing and memory chips. It's a dominance in a strategic commodity that's been developing over years, but now making itself felt as the world becomes increasingly technology-driven.
But from here on out, it's going to broaden considerably to a chips with everything model inside your fridge, loads of smart semiconductors in your electric vehicles, your cars. So it's going to have an ever-increasing importance going forward.
Like other car makers, this General Motors plant outside Seoul has been experiencing delays because of a global shortage of chips. It's been a wake-up call for many world leaders, but the investment of time and money needed to become a chip maker means South Korea and Taiwan will maintain their lead for years to come. It's a global shortage that's been made worse by the pandemic. When car factories ramped up production again late last year, it coincided with a surge in demand for consumer goods, also needing chips, and a move towards online activities, requiring greater data processing that needs, yes, ever more chips. Frank Wang is the founder of one of Taiwan's chip manufacturers, whose business has grown as the island has come to dominate the sector.
This is a very important way Taiwan will continue survive, prevail, for Japan, United States, and other European countries. Taiwan is so vital in their technology processor. If we have a problem, the world will have a problem. It's indispensable Taiwan right now.
Taiwan's chips are also indispensable to mainland China, providing it with a so-called silicon shield against Beijing's expansion in the region, but also raising the stakes in the increasing competition between China and the US.
So there is the potential this is actually going to increase friction. Taiwan's greater geopolitical importance, it has the potential to draw in Washington, Beijing and Taipei into this tri-party conflict and competition.
South Korea's and Taiwan's production mastery of a tiny component that makes any potential conflict in East Asia a matter of global concern.
Rob McBride ending that report from Seoul. And that's our show for this week. But there's more for you online at aljazeera.com/CTC. That'll take you straight to this page, which has entire episodes for you to catch up on. And that's it for this edition of Counting the Cost. I'm Darine Abougaida from the whole team. Thanks for joining us. The news on Al Jazeera is next.